The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and welcome to the Pensionmark webinar series on navigating investment choices. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end of the webinar, we will take some time to go through these. Now I'd like to introduce our guest speaker of Principal Financial Group, Rosemary Martinez. Rosemary joined Principal in 1996. As a relationship manager, Rosemary works closely with financial professionals to provide retirement consulting services to plan sponsors with pension plans between $10 and $50 million in plan assets. She is a local presence and key resource for assistance with client service needs, including plan design, investment selection and review, participant education planning, and compliance. Her insightful problem-solving and strong relationship-building skills are largely attributed to her 18 years of experience with Principal Financial Group in the retirement services industry, with a special emphasis on employer-sponsored 401k and 403b plans. And with that, I'll turn it over to you, Rosemary.
Thank you. Good morning, everyone. I'm excited to be here today to talk through navigating investment choices with you. As one of the leading retirement plan service providers, the Principal has been helping people just like you prepare for retirement amidst all kinds of markets for more than 70 years. And we certainly understand saving for retirement can be confusing. Everyone has their own unique ideas about retirement, and you probably have heard that saving for your future should be a priority. The great news is that you've all made the smart decision already to either enroll in your organization's retirement plan or to be here today with us listening and learning more about the retirement plan. And that's the first step to take control of your financial future. Does making investment decisions seem overwhelming at times? You're not alone. Are you unsure about the next step? Do you think you're invested correctly? We're here today to help you with tools and resources that'll give you these answers. So let's get going. Today, our discussion is going to be broken down into a couple of different sections. Let me move our slide here 1 second. Tori? There we go. Today we're going to discuss a couple of different things. First, we're going to review the basics of investing and talk through different investment options that may be available for you in your organization's retirement plan. We're going to discuss ways to determine if you're saving enough to help meet your retirement goals. And third, we're going to talk about ways to help stay on course. Sorry, I'm having a little bit of a problem screening through. So if you could.
Rosemary, why don't you just let me know when you'd like the slide to change, and I'll go ahead and help you out.
Perfect. Okay, reviewing your investment choices. First, you need to think, when do you think about investing? What comes to mind when you think about investing? What sorts of things do you think about? What kinds of risks do we take? How do we manage those risks? These are a couple of the questions we're going to cover in this section. So let's get started. Next page, please, Tori. The market has had some ups and downs in the past few years. You've all probably been aware of that. One of the most important fundamentals of investing is diversification. What does diversification mean? Diversification simply means spreading your retirement plan contributions among different investment options from a variety of different asset classes. With diversification, you may be able to get a return that will help you meet your goals, all while reducing the potential risks you're taking. However, of course, no investment strategy such as asset allocation or diversification can guarantee a profit or protect against loss in periods of declining value. Some possible reasons to consider diversifying your portfolio. First, by having a portfolio made up of a variety of investments across different asset classes, you may potentially minimize the risk of a single asset class, decreasing the total value of your portfolio. Reducing investment risk in your portfolio also may help guard against another risk, one we don't think of often. You're working out, you're becoming healthier. There's the risk of outliving your retirement savings. We're living longer, so that risk becomes a big one as well. Also, investing both in the U.S. and internationally may potentially reduce the risk of a decline in one country's market, pulling down the value of your entire portfolio. Diversification may help to diminish inflation risk or the risk that your portfolio will grow at a rate less than inflation. It's important to think about how comfortable you are with risk. Investment risk is the chance you take on how much an investment option will go up or down in value. Tori, please page. Let's talk about the fundamentals of investing here. To help ensure that a portfolio of investment options is diversified, there's a couple of things that you want to consider. First, review your investment options. Retirement plans typically make available to you numerous investment options from which you can choose. It's important to review your plan's available investment choices and make the elections that are right for you. Choose a variety of investment options. Instead of putting all retirement funds in just a few investments, putting all your eggs in one basket, consider allocating retirement funds among different investment options from a variety of asset classes. Rebalance your portfolio. Review how much of your portfolio is invested in different asset classes, and consider whether your portfolio is in sync with your risk tolerance, with your goals, with your financial situation, and retirement time horizon. Consider consolidating your balances. Consolidating your retirement account balances is one account could help you manage your asset allocation, because it can be easier to compare investment elections within one account than among multiple accounts. So if you have other accounts out there, other 401ks or 403bs, consider combining all of those so that you only have to monitor one. And lastly, monitor your investment choices at least annually, or when there's a significant event that occurs in your life. Review both your portfolio and the plan's available investment choices. Let's look at the next slide here. This chart looks really complicated at first, but actually it's very simple. Each of the colored squares represents a different type of asset class. For example, U.S. stocks, large, mid, and small cap, value, and growth. You'll see that alongside there. This chart gives you also some foreign stocks, bonds. The chart shows how each is ranked from best to worst for the last 15 years. Looks like a crazy quilt that Grandma made for us, right? As you can see, there's no discernible pattern. There's no method to the madness. Let's take a closer look at one of these asset classes. The yellow squares are the real estate investment trust, or REIT. If you look on here, if you click, you see the blue line on here. Following the line, you see that the annual performance of this asset class over the last 15-year period made for a pretty volatile ride, up and down, way down in 2007, back up a little bit, way up in 2012. Markets are unpredictable, and winners and losers change year by year. It's kind of like being in the fast lane, and then there's traffic, and you think that lane looks better, so you change over and all of a sudden it stops. How can you make sure you're not always in the slowest lane? This quilt kind of shows you how to do that. When you diversify a portfolio by holding investment options from a variety of different asset classes, the white squares in the middle show you an example. You are far more likely to spread out your risk and smooth the portfolio's performance. Spreading out your retirement funds across different types of asset classes, this is called diversification. This could be one of the best ways to spread your risk and potentially to reduce the impact of market volatility. Let's move on. What is asset allocation, and what role does it play in investing? Asset allocation is the practice of diversifying your portfolio with a mix of investment options suited to you. Through asset allocation, you could diversify your retirement savings to help achieve an overall level of risk you're comfortable with. To understand the role of asset allocation, it's important to know about the different types of investments or asset classes. Asset classes are groups of categories of investment options that generally align, each with its own risk and performance characteristics. Generally, asset classes with lower levels of risk usually offer a lower potential for growth. Meanwhile, asset classes with higher levels of risk usually offer more potential for growth, but may also have more of a potential for loss. These characteristics, the potential risk and return, are taken into account when planning an asset allocation for individual investors. Just remember, risk versus return. There's a variety of investment strategies. For example, adjusting asset allocation over time. As you become older and retirement becomes closer, many financial professionals suggest that your asset allocation should become more conservative as retirement nears. This means increasing the proportion of lower risk assets in a portfolio and reducing the proportion of higher risk assets. Also, using dollar cost averaging. By investing over time, ongoing contributions allow you to automatically purchase more shares of investments when prices decline due to market fluctuation and fewer shares when markets rise. Over time, this may reduce the average cost of an investment option. Dollar cost averaging involves continuous investing. Investors need to consider their ability and willingness to continue investing through periods of low price levels. This does not assure a profit again, nor protect against loss in declining markets. Just remember, keep on putting those contributions in regardless of whether the market is high or low, and automatically the dollar cost averaging will be done for you. Let's move on. How about the different categories of investments? The categories here are called asset classes. These asset classes group investment options with similar risk levels. An international equity investment generally carries more risk than a U.S. equity investment and has a potential for higher returns. Your short-term fixed income includes investment options such as treasury bills, CDs, certificates of deposit, and money market instruments. They're considered to be among the least risky form of investment options. Remember, as the risk level goes up, so does your possibility for higher rates of return. At the same time, while a risk level may produce increased rates of return, it also increases the chance for loss. If, for example, you have a long time until retirement or you have a high risk tolerance, it's more likely that you may want to choose a higher risk for higher potential for return portfolio of investment options. If, on the other hand, you have only a short time until retirement and you have a low risk tolerance, it's more likely that you may want to choose a lower risk, lower potential for return portfolio of investment options. So in other words, the longer you will be in the market, historically, the more you may be able to absorb those market lows and reap the rewards of market highs. while the opposite may be true as you approach retirement. Let's move on to how the allocation balance changes over time. Let's look at some more of the basics when it comes to investing. Over time, your portfolio allocations will likely drift from your original asset allocation goals. This is because each investment option will achieve different results, but your allocation or investment option elections remain fixed. Maintaining your allocation is important as it helps keep you in risk-return comfort zone that you originally chose, and it may help lessen your volatility. You can help maintain this consistency by rebalancing. Rebalancing involves exchanging retirement funds among investment options to return the original allocation that you chose. Many investment options rebalance for you. You should find out if that's the case. Try to review your contribution and investment elections at least annually, or as significant events occur, such as marriage or the birth of a child. You can rebalance your portfolio by usually logging into your provider site and selecting the Manage Investment section. Let's continue. How about the importance of missing the market? If we look at this slide here, it tells us a little bit about missing the market. None of us have a crystal ball. This is true. So we don't know when we should be putting money in, when we shouldn't be putting money in. So what you need to do is, like I said before with dollar cost averaging, stay invested at all times. This slide shows you the value of $10,000 of a $10,000 investment in the Standard & Poor's 500 between December 31st of 1993 and January 15th of 2014, of just this year. It shows how missing just the 50 best days can mean a big loss for you. But if you stay invested, if you stayed invested the entire time, you show on the bottom that your percentage would have been about 7.11% of an increase. So the important thing is, because we don't have a crystal ball and we don't know what's going to happen day to day, is to be invested, stay invested for all the trading days. Choose a mix you're comfortable with and stay invested. Let's go on. Here we're going to show you how to determine your investor profile. The investor profile quiz is a great 8-question quiz that's designed to help evaluate what kind of investor you are. This quiz should only take a few minutes to complete, and it may be very helpful for you when electing investment options. This quiz is also available online for you at principal.com/investor quiz. Regardless of who your provider is, you could take this quiz online. The quiz focuses on risk. Risk is actually defined as the possibility of loss. When it comes to investing, there's always risk. But think about it this way. You deal with risk every day in your life. So while you're taking the quiz, consider how much risk you take every day and equate that to investing. Risk tolerance can change over time as your retirement date gets closer. Plan to review the quiz periodically. Please keep in mind that this information is educational only, and it's just used as a guideline. It's not intended to tell you how to invest exactly, but you could use this quiz. After you complete the quiz, add up your total points to help determine which investor profile matches your time horizon and your risk tolerance. Let's move on. So, Rosemary, now what? What type of an investor are you? You've taken the investor's profile quiz, to help determine what kind of an investor you are and what level of risk you're comfortable taking. Remember to review those elections, like I said, at least annually or when there's a significant event in your life. Where are you invested? Check your investment choices. Is it time to rebalance? Rebalancing helps ensure the original asset allocation of the investment options you elected stays in place. So remember to do that. Let's move on. Let's look at the second point that we're going to talk about today. What do you want to do when you retire? You could spend 25, 30 years in retirement. We're living a lot longer. That's a second lifetime that is spent in retirement. It's your future, and you get to control it. Let's look at how much you may need for retirement. We've talked about investing strategies and the investment options available that could be available in your employer's retirement savings plan. Now let's move on to step 2 and look at your expected financial needs in retirement to help you determine if you're on track to meet your retirement savings goals. Most people are not saving enough to reach their goal. Some simple changes can help. You may need to save at least 10% of your pay plus any employer contributions if your employer makes the contribution as well over your entire working career to have enough income in retirement. This assumes you may need about 85% of your pre-retirement income to maintain your current lifestyle after you retire. My husband says I'll need 110% to maintain my style. Each individual situation is unique, though, so your savings and post-retirement needs may differ. Let's discover how your contributions can grow. As you plan your course to retirement, it's important to understand the impact of the contributions you make to your employer's retirement savings plan. A retirement savings plan not only provides the potential to build savings for the future, but the pre-tax contributions can reduce your taxable income. Let's look at this example. It could reduce your taxable income because pre-tax contributions to a retirement plan are generally not subject to federal income tax until they are withdrawn. It's also possible to defer taxation on any earnings from the pre-tax contributions held inside the plan until they are taken out at retirement. This can help your retirement savings grow faster. The table here on this page compares 2 situations, one in which an employee contributes 8% of his biweekly pay to his employer's retirement savings plan, and one in which an employee makes no contribution. Another thing to consider is compound earnings. Over time, contributions inside your retirement savings plan may grow because earnings are reinvested. Earnings could be generated on both your original contributions and the reinvested earnings. For example, if a contribution of $1,000 earns a 7% rate of return, the $1,000 contribution becomes $1,070. The additional $70 remains in the plan to potentially generate additional tax deferral savings. Generally, the longer retirement savings remain in the plan, the greater the compounding effect. Now let's talk about the effect your contributions have on take-home pay. It may actually be less than you think. It could be easy to make a few small changes to help you save more and have those savings potentially make a big difference over time. Let's look at this next slide. If you discover you're not saving enough, a simple strategy may be to increase your contributions over time. Take a look at this example of Elaine and Philip. They each begin contributing 8% of their pay to the retirement savings plan. Over 30 years, Elaine's retirement savings potentially grows more than Philip's. What did Elaine do differently than Philip? Elaine increased her contributions regularly for 5 years. In this example, an extra 1% a year for the first 5 years of contributing resulted in the potential for an extra $211,800. Notice the difference in the total contributions of Elaine and Philip. By increasing her contribution rate by 1% each year for just the first 5 years, her total contributions are just under $85,000 more than Philip's contributions, while her retirement savings topped his by more than, again, $211,800. Was this worth it to Elaine? I bet. Let's move on. Talk about reviewing your organization's retirement savings plan. Can we save and pay ourselves first so we can try to have the retirement of our dreams? Absolutely. So retirement can be everything we wanted it to be and then some. Let's look at our last topic bit, and that is staying on course. Tori, can you change the slide for us? Thank you. So we've talked about your investment choices, the importance of developing a plan for retirement savings. Now we'll talk about ways to help for you to stay on course with your plan for retirement savings. Some important things to remember on this next slide are to stay focused on your goals. Some things you could do to stay focused on your goal include, again, revisiting your contribution and investment elections at least annually or as significant events occur. And remember, pay yourself first. Going on, let's review the key details. As time goes on, be sure to review some of these key details of your plan for retirement. Something that's very important, people don't think of often. You should look at your beneficiary designation. Always make sure that your beneficiary designation is on file and has the appropriate person. A beneficiary designation states who is to receive the benefits and how benefits are to be paid in the event of your death. It's important that you complete and periodically update a beneficiary designation so any benefits can be paid out in an accurate and timely manner. Because circumstances change over time, it's a good idea to regularly review your beneficiary designation. If you get married, if you get divorced, if you have more children, remember to always keep your beneficiary designation reviewed. The amount you're contributing and the amount of the account balance, you could look at your statements, plan statements. That's one great way to stay connected and keep up to date on your progress. Review those plan statements. Most of you have access to doing that online. Some of you may review that when you receive them in the mail. And that leads us to the end of this section of our navigating investment options. What are you supposed to do after our time together today? Just remember, this is your future, and we all hope that there will be a day when we each retire. Let's take advantage of this time to plan so retirement could be everything you want it to be and more. In closing, I'd like to thank you for your time. We've reviewed a lot of information about retirement planning, so please don't hesitate to contact Pensionmark or your plan administrator. As I said earlier, by being here today, you've already taken the most important step towards retirement and towards a more secure financial future. Congratulations. Tori, can we see if there are any questions?
Yes, thank you so much. We appreciate you sharing your time and knowledge with everyone here today, and we'll go ahead and start addressing some of the questions that have been filtering in. Everyone, please remember that if you have any questions, you could submit them using the Q&A tool on the webinar menu. And as always, as Rosemary mentioned, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. Our first question, what qualifies as a diversified portfolio?
When you're talking about a diversified portfolio, we're talking about having investments in different asset classes. For example, in large companies, medium-sized companies, in small-type companies, in the U.S., and perhaps outside of the U.S. as well. So having a mix of investments, and like I said, not putting all of your eggs in one basket, not having all of your money in just one type of investment category or risk will help you potentially.
Great, thank you, Rosemary. It would appear that we have no more questions at this time, so this will conclude this webinar session. Again, thank you, Rosemary, and thank you, attendees, for your participation. I hope everyone has a great day, and we're looking forward to our next webinar series with you. Happy holidays, everyone.
Thank you.